Right, well, so that for those of you who don't know me, my name's Paul Mahoney. I'm the founder and managing director at Nova Financial Group. We are a property investment advisory company. We advise on pretty well all aspects of investing in property with a focus on achieving financial goals through property investment. So I'll talk to you a little bit more about that so that you understand the direction from which we're approaching this. And the topic of today's talk is the best buy-to-let strategies for 2020 and beyond. Now, of course, because this is a live webinar, we have the ability to make it as topical and as interactive as possible. So a good way that I like to start these talks is to get a bit of a read of the room. So if everybody can please turn your attention to the Zoom webinar chat function and just let me know where you fit in so far as being a beginner, an intermediate investor, or a more experienced property investor. Where would you sit, would you say? Just so they can get a bit of a read of who I'm talking with and make this as productive as possible. Okay, few beginners, few intermediates. Cool, okay. Good stuff. All right, that's good. That does give me a bit more information, which is always useful. Okay, excellent. Now, one other question that I've been asking in these webinars, again, so that I can try to tailor the information as much as possible to those in attendance, is what you would like from the talk today. So if you don't mind just plugging that into the chat section on what are the main things you would like to achieve from the webinar today, or the main things you'd like me to cover perhaps. Research, okay. How to look for good deals. Strategies on buying in today's market. All right, all good stuff. Gain knowledge, tips, strategies on the next steps during and post COVID-19. Buy-to-let strategies for these times. Sourcing techniques. All right. Okay, well, interestingly, a lot of what you're covering there is pretty relevant to the content that I'm going to go through. Given that, as I say, I do want to make it as interactive as I can. I'll try not to rattle on too much with too much content, but we will go through some. And as I say, any questions that anybody has now or that might come up throughout the talk, please direct them to the Q&A section. So if you just take your cursor down to the bottom left-hand corner of the Zoom meeting screen, you'll see Q&A, and that will give you the ability to plug some questions in there, which I will come back to and address at the end of this talk. Okay, so what I'll do now is I'll flick over to some slides and we'll go through some content, and I will kind of toggle back and forth between the two as we go, just to make sure that everything is making sense. I haven't lost you. It has happened. It did happen in one of the previous webinars where the broadcast cut out. So obviously I don't want that to happen, but we'll get into some of the slides now. Right. So, topic of the talk, learn the best buy-to-let strategies for 2020 and beyond. A little bit of a disclaimer to start with. We are a regulated company, so it's important for me to say that anything that I do say in today's talk is not specific to your situation. It is general in nature. You shouldn't necessarily act upon it. You should seek personal advice before making any changes to your finances or your investments. And that's something that we can help you with on a one-to-one basis. So we will cover quite a bit of information, both in the content that I've put together, as well as the questions and answers. I think the last webinar we did, we had about 30 questions and answers, which is brilliant. This webinar, as I say, we had over 100 people registered. So I expect it to be even busier, but that's great. That's what we're here for. That's what we want to offer. We want to offer value and education in a difficult time where most people are stuck at home and have the time to digest and learn from that information. So hopefully I'm hoping that we can be of good value. First off, the agenda. So I'll start introducing us so that you understand what we do. I know that I've seen some of the names that are registered. Some of you definitely already know who we are, and some are even clients, whereas others perhaps may not. So I'll introduce us and what we do. I'll talk about the importance of strategy, why we feel as though strategy when it comes to investing is very important, why specifically leveraged property, not just property investment in general, risk versus reward, key fundamentals, some of the current market trends, and some 5-year predictions on growth. So I'll get through some of these initially. I'll toggle back. I can go through sort of a couple of questions perhaps, and then come back to it again. So first off, us and what we do. So Nova Financial Group is our sort of head brand, if you like. Underneath that, we provide a range of services. It's very much an end-to-end or one-stop shop, if you like. And what we do is we advise on all aspects of property investment. So first off, helping clients better understand their current situation and their goals. So, what is point A, what is point B, and then how they're going to get there. Cover a little bit more on that in a second. Once we have a strategy, then actually implementing that strategy. So doing the research and due diligence that's required to, excuse me guys, this has just died, sorry about that. Doing the research and due diligence that's required for sourcing the right property investment specific to your situation, your goals and preferences. Financing those properties, so we have an in-house mortgage brokerage. Managing those properties, we also do property management. And then reviewing and reinvesting to help you build a portfolio of properties and actually achieve financial goals. So we're very focused on the end outcomes, the goals you're working toward, because at the end of the day, most of us invest in property to make money. We don't do it for fun. We do it to improve our financial position and achieve an end goal within a specified time frame. So that's effectively what we assist our clients with. What makes us different mostly is the fact that we're independent. So we don't have anything to sell. It's all very much tailored to your situation, rather than there being a book of properties that we're flogging, which is the way that unfortunately most property businesses work. We very much source individual opportunities specific to our clients' needs. So in a nutshell, that's what we do. Essentially help people make more confident and educated decisions than if they were doing it on their own. So I spoke about point A and point B. So point A being where you are now. Point B being where you would like to be. And it's very important to have a strategy for getting there. And an analogy that I sometimes use for this is it's almost, not having a strategy is like jumping in your car and driving aimlessly. You're probably unlikely to end up somewhere desirable. And even if you know the desirable location that you would like to end up, unless you know how to get there or you have a roadmap for getting there, you're probably unlikely to get there. But that seems extremely logical when I say it in that way. But it does surprise me how many property investors of varying levels of experience, especially the more experienced ones, that don't necessarily have a strategy and have just acquired property in a very ad hoc fashion. They see one they like, they buy it and hope for the best, and they've acquired a few over a period of years. Whereas, of course, if we have a much more strategic approach, a criteria, and an understanding of what works best for you and why, then we're probably far more likely to achieve the right outcomes. So that's our logic anyway. That gives peace of mind. It allows us to account for contingencies. So if we're under accounting for returns, over accounting for costs, for example, then we're unlikely to be surprised to the downside. Not reinventing the wheel. This is very important. You know, as individuals, we're all limited by our resources, myself included. You know, I've only got so much time, knowledge, experience as one person. And I'd like to think that as a person, I'm relatively experienced in comparison to most, but I don't know everything and I haven't experienced everything. You know, as a business, we have those resources in abundance compared to any one individual. So we can help people avoid mistakes that they may make on their own. And some people might say, well, look, you learn from your mistakes, and you do, but why make them if you don't have to? So using a resource like that is quite useful. You know, learning from people who have done it before. You know, in my experience, the most successful people are those that have learned from other people's successes. Taking a business approach. So I think pretty well all industry sort of experts and speakers will agree with me that in the current market and with all of the recent changes regarding Section 24, stamp duty, mortgage serviceability, portfolio landlords, etc., property is not a hobby anymore. You need to have a business approach. You need to have a strategy because there's a bigger gap between what works and what doesn't. And therefore, you want to be on the right side of that fence. And lastly, that there was a study done of Harvard MBA students in 1985. So the class of 1985 Harvard MBA students, they asked them 3 questions, and those questions were: do you have goals? Firstly, are they clearly defined, and are they written down? Do you have clearly defined goals? Are they written down? And do you have understanding of how you're going to achieve them? That was the 3 questions. 3% had all 3. 17% had goals, but they were not written down and they didn't really know how they were going to achieve them. And 80% didn't have any of the 3. Now, they surveyed the same group 10 years later, and the 3% were earning 10 times as much as the 97% combined. So the point there is just by taking the time to write your goals down, what they are, why you want to achieve them, and how you're going to achieve them, even if that changes every day, you're far more likely to achieve them. I'm just going to toggle back now. That's great. We've got 1 question already, which I'll come back to. But guys, as I say, I can't encourage you enough to plug all of your questions into the questions and answers section, because I do feel as though that's very valuable. And it's something that we'll go through at the end of the talk. Great to see that we've got some more people joining us. Welcome. Right, so just toggle back to my screen. If I can just turn your attention to the chat function again. Just let me ask, of those in the webinar now, who sat down at the start of 2020 and wrote down their goals and a brief strategy of how they were going to go about achieving them? Who did that? And also, who didn't and why? Always really interested to hear people's take on this. You know, it's definitely something that I did and I believe in. I'm not a spiritual person in any way, shape or form, and that's just my personal opinion. But I do believe that taking the time to write things down and getting an understanding in your own mind of how you might go about achieving that goal does put you in a position of being far more likely of achieving it. Good, you did, but COVID-19 sent it out the window. That's a fair point. And look, that, as I say, that's why I'd like to make this as interactive as possible and answer as many topical questions as possible, because I know there are a lot of questions in people's minds at the moment. So hopefully I can be of some level of assistance there. Okay, yep. So quite a lot of people did, which is great. Obviously times have changed quite a bit since the start of this year to now. We're only at the start of April. But I suppose what probably isn't a bad idea now is to take another look at those goals and how you were thinking about achieving them. because, you know, maybe that has changed. I suppose although there is a little bit of uncertainty in the market at the moment, and that's what I meant before when I said, you know, your goal and the strategy for achieving them can change all the time. It doesn't have to be set in stone, but it still makes sense to understand these things. That's why you're interested in Nova. Good to hear. Good to hear that you're interested in our assistance. Okay, guys, I'm going to toggle back to the screen now. But again, please keep in mind, please do plug any questions you might have into the Q&A section. And we'll come back to those at the end. Good. Okay. What's going on here? All right. So now, why leverage property? So specifically there, the word leverage property. So properties with mortgages. Mainly, you know, my background is financial planning. To give you a little bit more background on me, I previously ran a large financial services company in Australia. We publicly listed in 2014. I left, came to the UK and started Nova. We're a property investment advisory company, but we very much approach things from a financial planning perspective. So, you know, we looked at everything as a potential investment option for, you know, a broad range of people. And cash bought property is okay. And when you compare it to the likes of shares, it's pretty similar, a little bit more stable, but returns are similar. Leverage property, in my opinion, is a game changer. It really, there is no comparison to leverage property when you look at it from a risk versus return basis, and also a confidence in return basis. And what I mean by that is the fact that I can take £50,000 and invest in a £200,000 asset means that by achieving relatively average returns on the £200,000 asset, I can get really strong returns on the cash I've invested. So for example, there's some figures here. What we generally aim for in the current market, based upon current achievable yields and current interest rates, is a net yield on funds applied. So on my 50 grand, not on the asset value, on my 50 grand, of between 5 to 10%. Sometimes we can get more than 10%, but 5 to 10% is quite achievable. So using that same example, that gives me £2,500 to £5,000 of net cash. So post all expenses, pre-tax, but that's the cash going into my pocket. And that's just the yield side of the equation. That's actual cash returns. On the growth side of the coin, the UK average for the past 20 years per annum, including 2 major recessions. So we had the tech bubble in sort of 99, 2000, and the last financial crisis of 2008, where prices dipped but then recovered. Per annum, the average is 5.5%. Okay, so if we scale that back slightly to 5% on my asset value gives me 20% on the cash. Just to put that another way, 5% uplift in value on my £200,000 asset makes the asset worth 210,000. So that's a 10 grand return on my cash. 10 grand on 50 is 20%. So if I'm getting that every year, average over a 7 to 12 year period, which I'm going to be pretty confident in doing, I'm able to achieve a return of 25 to 30% per annum on the cash I've invested. Now, that's all pre-tax, but it's post all expenses. So it's a net pre-tax return. Now, in my experience as a financial advisor of about 12 years, there's no other asset class that you can do that with that level of confidence, and also the fact that your asset is tangible. You know, it's often made of bricks. It's not going to disappear. And if we're investing in the right properties in the right locations, and I'll get to some of that in a moment, what we feel as though the right properties in the right locations are, you can have a certain level of confidence that you can definitely get that return as an average over a mid to long-term time frame. So that's why we like leverage property. Key fundamentals that we look for. So first off, strong tenant demand. So very large tenant pool and strong demand for the specific type of property we're investing in. strong employment, and a broad range of industries. So remember that most of us live where we live because it's relatively close to work. And the tolerance for travel to work is without doubt reducing. Young professionals want everything on their doorstep. They want jobs, bars, restaurants, cafes. Unfortunately, not at the moment, but hopefully we're back to all of that stuff pretty soon. But that's what they want. Now, therefore, it makes sense to invest with that trend. I'll give you a great example. 20 years ago in Manchester city centre, there was only 1,000 people living there. It was mostly retail and commercial space. Today, there's about 30,000. So in a 20-year period, there's 30 times the amount of people living in a relatively small space of about 2 square miles. That's had a huge impact on that location, and that is a continuing trend. I read a report recently that said that currently about 50% of the world's population lives in urban areas, so central city areas, and over the next 20 years, that's expected to increase to more than 60%. That's 10% of the world's population, which is billions of people, moving from rural areas to urban areas. That's a very strong trend. It makes sense to invest with those trends because we're investing for the long term. Infrastructure, so large being roads and rail, small being shops, restaurants, cafes, gyms, things like that. Essentially what we're looking to do here is tick as many of the boxes as we can for what tenants and future buyers want. Tenants we can understand, so who is our target market? Is it a young professional? What does that person want? Future buyers is a range of things. It's not just landlords. In fact, it's more likely to be owner-occupiers, which is a bigger chunk of the market. So how do we appeal to that resale market in the future? Because that's what drives up your price. And that's the key to desirability. You can buy cheap and nasty properties that will probably rent reasonably well in good areas because there's rental demand, but they won't usually sell very well, aside from perhaps to a landlord based upon the yield, which is somewhat limiting your resale market. Socioeconomic levels, so the demographics of your target market are important to understand. Who is your target market? What are the employment rates? What are the vacancy rates? All of the stats. The Office of National Statistics is a good source for this information, but also what do they want? So making sure the demand is skewed in your favor. If we're investing in central locations, single occupancy and dual occupancy are the main type of household makeup. And therefore, a one-bedroom apartment or a two-bedroom apartment makes the most sense. If we're investing in a family-oriented area, then probably a three-bedroom house makes the most sense. You need to make sure that demand is skewed in your favor. A good balance between yield and growth prospects. I mentioned before about the shifts in the market with regard to Section 24, stamp duty, mortgage serviceability. All of these things are making a yield buffer more important. A bit of extra tax doesn't hurt as much if you've got more yield. Serviceability on mortgages doesn't hurt you at all if you've got a higher yield. And this is causing a shift in the market more toward lower value, high yielding assets. What we're looking for is positive growth and change. Some people we speak with just assume that property grows in value for no particular reason. It doesn't. There needs to be a reason. There needs to be growth factors or essentially a reason for demand to outstrip supply. And some of these key things is what drives that. Good to see that some people are plugging in some questions, which is great. We've also got some more. We're up to about 60 participants now, which is brilliant too. So yeah, please do plug any questions into the Q&A section. So you'll see here this dartboard. Now, based upon these key factors that I've mentioned here, generally you'll find that where you have most depth in each of these factors will be the center of or surrounding areas of major cities. That's where you have the most reason for people to want or need to live in that location. And therefore those locations tend to be much more sustainable in bad economic times. I wouldn't necessarily, people are certainly saying that. I'll come back to that in a moment. But, you know, to give you more confidence in rentability and saleability, you want as many of these factors as you can. And when you're investing in locations with broad range of industries and employment, a broad range of facilities and amenities, giving people more and more reason to want and need to live there, that's what gives confidence in sustainability. If you go further out from those locations, the more those factors tend to thin a little bit, and therefore, in my opinion, the less confidence you can have in demand. Risk versus reward. So we always aim to have the risk-reward ratio heavily imbalanced in our favor or our client's favor. So, you know, I mentioned before about having desirable properties in good locations that are going to rent first and sell first. That's one way of mitigating that risk. But of course, then you need to get a good balance between value as well, you know, paying the right price. I'll just toggle back just to make sure there's no issues, because I see a couple of people are asking some questions. Okay, good. Just to answer that question there, yes, we most definitely can help with strategy reviews. Is everyone still hearing me fine? The picture, the sound, everything working okay? You just don't mind commenting in the chat section there. Excellent, good. Thank you very much. Just want to make sure I haven't lost anyone. All right, good. We will get back to the screen. We haven't got too much more content. Just as I say, I don't want to bore anyone. But if you do have any questions, please do plug them into the questions and answers section. Right, so we'll come back to the screen now. All right, so we're looking for an imbalance in our favor. We want to be focusing on areas with low vacancy rates, because that shows there's an undersupply in comparison to demand. We want to be paying fair value. Now, the reason for that terminology of fair value and not cheap properties is, in my personal experience of investing in property and in the experience of advising, you know, tens of thousands of people on property transactions over the years, the properties where you got a cheap property and you think you got a good deal will usually be outperformed by the properties where you begrudgingly paid fair value because lots of people wanted it. You know, cheap properties are usually cheap for a reason, whereas really good properties usually have really strong demand for them because people aren't silly, and they see that, they see those factors. I spoke about the importance of a yield buffer. Just means that the whole investment is more safe. If you've got a strong net yield and that builds up over a period of time, you can cover things like expenses. You can cover any potential vacancy rates, vacancy periods. You know, cover your mortgage, all those sorts of things. Cash is king at the end of the day, especially in a crisis. So, you know, tangible assets in desirable locations is really what we aim for. You know, good quality properties in good areas that are going to have strong demand. Okay, current market trends. So, first off, I mentioned before about the trend of young professionals moving towards central locations. And one way we describe this is the substitution of space for place. Now, the traditional dream of having the larger family home away from town is not so much the dream anymore. Now, when I'm talking with younger people about this, they mostly all seem to get it. When I'm talking with more experienced rather than elderly people, more experienced people about this, sometimes they struggle to understand this because perhaps it's not their exact preference. So, you know, there's an old Australian, obviously I'm Australian, there's an old Australian term of having the quarter-acre block with the garden and the picket fence, and that kind of being the family dream. That's very much not the dream of young professionals anymore. And part of the reason for that is young professionals are working longer hours, generally in central locations. They're getting married later and they're having children later. And therefore, the period of time for which they are comfortable having the centrally located 2-bedroom apartment, for example, is much, much greater. And I can certainly, relate to that myself, but also for, we've got a team of 20 plus staff here in the City of London. And that's definitely the preference of predominantly the preference of the team here as well. City centre living, younger generations moving or staying north. And that's the north of England. I'm sure a lot of you have seen, newspaper articles and media about the transition or the transient population in the UK, more so away from London and the southeast, which has become very expensive, toward places like Birmingham, Manchester, Liverpool. It's again something I can understand. Relating it back to our team here, if we have a graduate on an average London graduate wage, for them to buy a property in London anytime soon is almost unforeseeable or unachievable. It's going to be very, very difficult for two reasons. Firstly, they need to save the deposit, and maybe Help to Buy helps them with that, but they still need 5% plus stamp duty. The second reason is they need the income to support the mortgage. And that's very, very difficult to achieve as well, which Help to Buy doesn't really help with, because you still need an average income of, upwards of 60, 70,000 pounds to buy a decent property in London using Help to Buy. So a lot of these people are either moving north from the south, or they're staying north, whether that be that they're from there or they went to university there. Obviously, there's lots of really good red brick universities in the north of England. And previously, people who either grew up there or went to university there would come to London because this is where the jobs are and this is where the opportunity is. That's not so much the case anymore. Manchester, for example, 85 of the FTSE 100 companies have big offices in Manchester. Ernst & Young move thousands of jobs there. Deutsche Bank and HSBC move thousands of jobs to Birmingham. There is a big trend, not just for young people, but also for major companies moving significant portions of their staff there. More focus on yield. A little bit of a typo there. There is a shift toward lower value, higher yielding properties away from higher value, lower yielding properties. And the main reason for that is the kind of almost a cliche strategy of investing in London and just breaking even yield wise, but investing solely for growth doesn't really work anymore. And I'll give an example as to why. The average property price in London is about £500,000, and the average yield is about 3.5%, which means based upon current benchmark rates that the Bank of England mandated that all buy-to-let lenders needed to use, you can only borrow about 60% on that property, which means that you're putting in at least £200,000 in cash to a £500,000 investment that's only just going to break even cash-wise, and therefore you're speculating solely on growth in a market that's already grown substantially. That doesn't make much sense in my whereas you could take that same 200,000 and buy 3 or 4 properties in a major northern city like Birmingham or Manchester, get a much better net yield, and arguably get much better growth potential as well. So, I'm certainly not the only one that has that attitude, but that's definitely the strategy that I've personally been following for a number of years now, and that most of our clients have been following as well. And that there is definitely safety in desirable, centrally located properties for all of the reasons I already discussed. Okay, now lastly, this is a graph from a recent report by Savills. Now, they released this report about 2 or 3 months ago. However, they also redid the report about a week ago, taking into account COVID-19. The figures for 2020, they changed, so let's just disregard those for now. But the 5-year figures, they didn't change at all. And essentially what they were saying there is that they don't feel as though COVID-19 is going to have any real impact at all on 5-year growth figures. Given it's a relatively long period of time, and I suppose in their opinion, and I would tend to agree, that hopefully COVID-19 is going to be a relatively short-term thing. But what's very interesting about this is that the main areas that they're predicting growth are the northern regions. And if we were to dig down a little bit deeper than that, my opinion would be that it would be the major cities within those northern regions that will probably even outperform these figures. Good. What's going on? Okay, so I'll come back. So we won't worry about this stuff. I'll show you some other pages in a moment. But I'll stop sharing my screen if it will let me. Oh, that's fine. Okay, so screen sharing stopped. Is everybody finding this useful so far? Turn your attention to the chat section. Finding it useful, everyone? Feel free to tell me no. I've got thick skin. Good, okay. I'm glad everyone's finding it useful. I'm sure not everyone is. I'm sure there are some silent people there that are thinking this guy doesn't know what he's talking about, but that's okay. All right, so let's turn our attention now. Actually, I'll just round out the talk, and I'll just talk slightly more about us and how we might be able to help, and then we'll come to the question and answers. But if I can turn everyone's attention to the question and answer section, we've still got 56 people in the webinar and only 10 questions. We can do better than that. Any questions you have in your mind whatsoever, turn your attention to the bottom left-hand corner, then questions and answers, plug them in there, and I'll come back to them in 2 minutes and work my way through them all. Some people have got their hand up, but I'm not quite sure how I'm able to answer you. If you're having issues with the question and answer section, just plug it into the chat section and tell me, and we'll try to get it resolved. But what I'm going to do now is just talk a little bit about how Nova might be able to help. Anybody who is looking to put in place a strategy. I'm a bit repetitive from the last, okay. If it's the same webinar, then yes, of course, I'm going to be a bit repetitive. If it was the how to create passive income one, then, you know, look, I suppose at the end of the day, we have our approach to property. So I might tend to repeat myself a little bit because I suppose at the very least I'm consistent. But thank you for the honest feedback. All right. Right, okay, so what we are doing for the webinar attendees, and I'll just share my screen with everyone, is so we usually offer free face-to-face consultations with potential clients to determine if there is a fit between what you're looking for or how you can improve and what we do. That is essentially a free review of your current situation to see where you might be able to improve. If there is a fit there, we usually charge a fee, which ranges between £500 and £2,500, depending on the complexity of your situation. What we're offering is to waive that fee. So rather than charging you money to provide advice, if there is a fit there, and we won't engage with everyone because there's no point wasting everyone's time unless there's the potential for a mutually beneficial relationship. But if there is, rather than charging you an engagement fee, we will do it for free. So that will obviously be via video conference, given the current situation. But all of our advisors are still working. And of course, therefore, we can still be of great value. So what you all will all receive an email and a text message following this webinar. And if you are interested in an initial chat about that to see whether we can help, then just feel free to reply and we'll organize a suitable time for at least the initial conversation on the phone, but then obviously the video conferences thereafter. So this is our website. Lots of educational materials on there. eBooks, there's about 100 hours of video. So I host a TV show called Proper Wealth, which is on Sky, and feature another one called Property Question Time. I also wrote this book, which is now an international seller in the UK and Australia, and it goes into a lot more detail on all of the points that I've just covered. You can get that for free on our website by clicking on this banner, which will take you here, and you just have to pay for postage, which is £5. So if you're interested, if you've got some spare time and you'd like to read the book, then you can get that there. You can also get the Audible version of the book here. So it's both hard copy. It's usually £15 on Amazon in hard copy, £7 in ebook version. I think it's about £7 in Audible version as well. But you can get a 30-day free trial to get it for free. All the TV stuff, the podcast. So just essentially just taking you through our services. We've got all very positive testimonials, which isn't loading for me, but across all the main platforms. And look, that's probably enough about us for now. But any way in which you think you might be able to improve your finance structures, so reviewing your mortgages, reviewing your strategy for investing in property, and potentially could benefit from, the advice of people who do this all day, every day, and I'd like to think are pretty good at what we do, then feel free to get in touch following the webinar. So I'll turn my attention now to the questions and answers section. And any further questions, please feel free to plug those in. So first off, with regards, okay, so I'll just answer live. With regards to mortgages, how do you transition from a full-time job to being financially free from property? Struggling to understand how to get mortgages. Thank you. Okay, good question. Now, I assume the question you're asking is how do if I was to leave my job, how would I then get a mortgage? And I think what you're getting a little bit confused between here is the difference between a buy-to-let mortgage and a residential mortgage. So residential being the mortgage you would get on your home, buy-to-let being mortgages for investing in property. Now, residential mortgages, the serviceability for that mortgage is your income. So it's impossible to get a residential mortgage without having enough income to service the debt. Buy-to-let mortgages, the serviceability for that mortgage is the income from the property, not your personal situation. So long as you already own a property, and especially if you already own buy-to-let property, so you have a home and you're a landlord, you don't need to necessarily have an employment income to get mortgages. Now, little caveat to that, some lenders will want you to have a minimum income, but a lot will consider property income as well. Some might want £25,000, whereas others are fine with you having no income, so long as you have sufficient resources to live. So hopefully that answers your question. You don't necessarily need employment income. You certainly don't need a lot of employment income to be able to get buy-to-let mortgages, because they are a commercial mortgage and the serviceability is the rent from the property itself. So hopefully that helps. If I haven't quite answered anyone's question, feel free to plug in another one or make a comment in the chat section. And also, we're now just over 45 minutes into the webinar. If you have to leave, then of course that's fine. But feel free to follow up after this in response to the emails or to give us a call if there's anything you would like addressed that's perhaps more personal to you. Okay, next question. What services can you offer and what is your fee structure? Okay, so hopefully I've covered this a little bit already so far as the services we offer, but essentially we advise on understanding your current situation, setting goals, implementing a strategy, the research and due diligence that goes into sourcing properties, mortgages, so financing those properties, managing them, and then working with you on an ongoing basis to help you build a portfolio and achieve goals. In a nutshell, that's what we do. Fee structure wise, it depends on what we do for you, but I mentioned before that we usually charge an engagement fee or an advisory fee that we're offering to waive for webinar attendees, so that's quite valuable. I'm supported by a team with over 100 years of experience. We're all in property investors ourselves, so we know what we're doing. But generally, how we make money is if we source a property for you, there's usually a fee that we can get from the vendor. If we do a mortgage fee for you, the usual fees that are associated with mortgage broking. If we do property management for you, there's a fee for us there. So it's very much mutually beneficial. We only really earn fees when we do something to help you improve your situation. Hopefully that answers that question. Next question. What is the minimum investment pot you would work with? Okay, that's a good question too. There's not really a minimum to work with us, I wouldn't say, but there is somewhat a minimum determined by the market. What I mean by that is, in my opinion, there's not all that many properties worth buying in the UK, depending on where you are, but certainly not in the areas that we focus on, under about £100,000. There are lots of properties less than 100 grand, but they tend to be in cheaper, less desirable locations. And some people might disagree with me, but that's my opinion. Therefore, if we're looking at a 75% mortgage plus some costs, you're looking at minimum cash of about 25 to 30,000 pounds, probably slightly more than that, to start considering some decent property purchases. In short, so there or thereabouts, 30,000 pounds to be able to get into the buy-to-let market. Next question. Sorry guys, just so I stop sniffling, I'm just going to blow my nose very quickly. I'll be back in 1 second. Sorry about that, but I don't want you all listening to me sniffling. Okay, good. Next question. Is it better to get interest-free only mortgages or principal payment mortgages? Excellent question also. Sorry, just David, that question that you've plugged in there, if you don't mind just plugging it into the Q&A section so that I can come back to it at the end. But I will answer it for you. So is it better to get interest only or principal and payment mortgages? Right. So again, it depends whether we're talking residential mortgages or buy-to-let. Residential is obviously a personal choice, but generally I would say with residential being the home you live in, it's better off principal and interest, so you're paying down the debt, because that is personal debt. And just to explain, in my view, the differences in debt, there's good debt and there's bad debt. Good debt is investment debt. It helps you better utilize your resources. It helps your money go further, and it's generally tax deductible. Bad debt is personal debt. It's things like credit cards, car loans, home loans. It improves your lifestyle, but it hurts your finances. You want to get rid of that as soon as you can, but we all have it. Okay, so that being considered, buy-to-let, I would say always have an interest only. The reason I would say always have buy-to-let interest only is it's less risk. Now, some people would disagree with me there. They would say, well, why is it less risk? Because if you're paying down the principal, surely that's less risk. But with interest only, you have a smaller commitment on a monthly basis. And with most interest only mortgages, you can still repay up to 10% of the principal per annum. So you can get rid of it within 10 years pretty easily on an interest only basis. So it's not stopping you paying extra, but it gives you the flexibility to not have to pay extra. And therefore, if you run into cash flow problems, you have less of a liability. So I would say with residential, you're better off with principal and interest, get rid of that debt. With interest, with buy-to-let, there's no harm in having interest only, and in fact, I would recommend it. Hopefully that was useful. Next question, what exactly is leveraged property? Well, look, leverage is just a term for debt. So you're leveraging your money. I'm taking 50 grand, I'm leveraging it up to 200 grand with a 75% mortgage. It's financed property or mortgaged property. That's pretty straightforward. And as I mentioned, really that is the differentiating factor when it comes to returns on your cash. Cash bought property isn't great. It's the leverage that makes property great, because it means that by achieving pretty average returns on the asset value, you can get really good returns on your cash. Okay, hopefully that was a good answer. Next question. I have exchanged on a flat, which will only be completed in September 2020, probably later now because of COVID-19, through a limited company. It was too early for me to get a mortgage offer at the time of exchange, but based on my research, there were a few good deals at 75% loan to value. Where do you see buy-to-let mortgages going in the second half of the year? Okay, that's a really good question. The reason it's a really good question is the buy-to-let mortgage market, or in fact, pretty much the whole UK mortgage market has been put on pause at the moment. What I mean by that is it's very difficult to progress mortgage applications at the moment. And the main reason we're getting for that from lenders is that a lot of them have been overrun with mortgage holiday applications, and their resources are already depleted due to COVID-19 and most people working from home. So most of them aren't progressing mortgage applications at the moment. And therefore we're getting some questions around, well, are 75% loan to value mortgages still going to be available? I would say almost definitely yes, they will be, but when we get back to normal. And you know, I don't have a crystal ball. I don't know when normal is going to be, or even if it will be completely normal again. But I would hope, and I think most people would agree with me, that we will see that the worst of this by around June this year, and kind of be somewhat moving past it. So tying into your time frame, you should be fine for getting a 75% loan to value mortgage by completion of 2020. I wouldn't have thought you'd have any issues with that. Obviously, there's the discussion around where values are going to go between now and then, but depending on where this property is and tying it back to the key fundamentals that I went through in the talk earlier, so assuming this is a desirable property in a good location with strong reasons for people to live there, like employment, facilities, and amenities, there will still be demand for it, and it's pretty likely to hold its value. Hopefully that answers that question. Okay, next one. I really want to grow my investment pot as quick as possible by using buy, refurbish, and refinance strategy to recycle my money. Do you source properties suitable for this? If so, who is responsible for costing refurbishment works, procuring builders, and calculating end values? Okay, so predominantly we do not get involved in the more proactive approach of buying, refurbishing, and refinancing. And the main reason for that is that strategy is not suitable for anyone by any stretch of the imagination. I think a lot of people a lot of people I speak with assume that is the quickest and best way of building wealth quickly. And unfortunately, it's just not the case. In some cases, it can work really well. In other cases, it can go really badly. And unless this is something that, you know, you have the time, knowledge, and experience to do, you are taking a big risk in doing it. There's that. You know, that type of strategy and what's most suitable for most people very much depends on those things. You know, time, knowledge, experience. If you're a full-time professional, for example, that's never invested in property before and doesn't have the time and knowledge the time to manage these things, that is not a strategy that's suitable for you whatsoever. If you're a builder that has lots of time on your hands, then maybe that's a great strategy for you. But that very much depends on those two ends of the scale. Another thing is that when you actually look at the returns from a lot of these projects, you know, buy, refurbish, refinance, or buy, refurbish, flip, quite often people are aiming for a return of about 10 to 15% uplift in value. Now, a lot of our clients invest in well-priced off-plan properties and tend to achieve about that same uplift in value simply over the build period by doing nothing. Now, that's partially due to our buying power, that we're able to source the right properties at the right prices, but also the fact that they're in the right locations with the right driving factors that, you know, means that prices are increasing over that sort of 12 to 18 month period. Now, I know if I can achieve a 10 to 15% return by doing nothing, and the risk of that uplift having nothing to do with my ability, then I'd prefer that than, you know, getting my hands dirty every day for something that looks really easy but isn't a lot of the time. Now, I don't want to come across negative here because I'm not. That strategy can work really well, but and you shouldn't be doing it because you saw on Homes Under the Hammer that someone made loads of money. That's kind of my take, but it very much depends on your situation and what works best for you. Okay, next question. Carolyn. Hi, Carolyn. How are you? I know you well. How can I raise a mortgage or funds to buy if I no longer have an income? All right, so this is somewhat similar to the previous question that I answered. I assume we're talking about buy-to-let mortgages here, and assuming that you already own property. Even some lenders will lend to first-time buyers with lower levels of income, but especially if you already own property, the serviceability for the buy-to-let mortgage is about the rent from the property and not about your personal situation. So long as you have resources to support your lifestyle, then you shouldn't have any issues getting a mortgage, even if you have little or no income personally, because it's a commercial mortgage rather than a residential mortgage. Okay. All right, so loads of questions, guys, which is great. Thank you for keeping these coming. Right, next question. Ravi, how are you? I also know you are. How can I raise finance when the banks are withdrawing from buy-to-let? Okay. So there's a bit of an assumption made there on banks withdrawing from buy-to-let that they aren't. Banks are not withdrawing from buy-to-let. They are putting things on pause. Now, the worst thing you can do with this type of thing is pay any attention to the media. There was an article in the Financial Times which came across pretty negative, but they were talking about Lloyds and Barclays reducing loan to values substantially. Now, banks are not withdrawing from buy-to-let. They're simply putting things on pause whilst we are, you know, in a pretty major crisis, unprecedented crisis of almost every person in the UK having to work from home aside from key workers. So they're not withdrawing from buy-to-let. If you need the mortgage in the short term, or you're expected to complete in the short term, then the most sensible approach is to go to the vendor, whoever you're buying from, and get an extension of time, because most people understand the fact that you will need that, and that is not your fault, that you need more time for the mortgage market to come back to a sensible environment. Hopefully that answers the question. Next question. Will you ever have offices in Scotland? Well, we might. We don't currently have offices in Scotland. Our main office is in London, and we have satellite offices in Birmingham and Manchester. But we do have a lot of clients in Scotland. So, you know, obviously I'm offering this webinar via correspondence at the moment, and we do a lot of client meetings via correspondence as well. So we have clients all over the world, and Scotland is much closer than, you know, Saudi Arabia and Australia, which is where we have lots of clients as well. So we can still work with you regardless of where you are. Next question. I have 4 buy-to-lets. Can I incorporate them and use capital gains relief? Okay. There is a very long answer and a very short answer to this, and I won't go too in depth to the long answer because although I could, I'm not a tax advisor, I'm not an accountant, but this is obviously a very common question. Capital gains, so I assume what you're referring to when you say capital gains tax relief is incorporation relief, to prove that, and to do that you need to prove that you're in business and you're a full-time landlord. So far as incorporating, there's going to be costs regardless. You know, it's not just capital gains tax, there's also stamp duty. We get a lot of questions about, should I be incorporating my portfolio? And generally the answer is unless Section 24 has caused you major issues, you know, for example, high levels of leverage on low yielding properties and makes your portfolio unviable, then generally it's not worth it. But what you most certainly can do is incorporate for future purchases, if that's suitable for you. If you're a higher rate taxpayer and you're investing for the long term, maybe that's a suitable option. That is something that we can help you decide. So that was the short answer. So hopefully that was useful in some ways, but more than happy to have a more in-depth conversation with you on a one-to-one basis. Next question. What is the typical age group of a person coming to Nova to get advice? All right, good question. So we work with people of a very broad range of ages, anywhere from people in their mid-20s through to people in their mid-60s and beyond. But I would say our typical client is what I refer to as a mum and dad investor. They're generally, because we're in London, they're generally of a slightly above average sort of wealth band, if you like. They have spare resources, whether that be cash or equity in properties. They generally have an income as well, and they would like to better utilize what they've got. That's kind of what we specialize in, is helping people who aren't property experts, because not many people can class themselves as an expert in anything, but who would like assistance in better utilizing their resources to achieve financial goals at some point in the future. And as I mentioned, we like leveraged property as the best way of doing that with the most confidence. So typical age group, I would say somewhere between 45 and 60 is where most of our clients fall. I suppose that's where most people start thinking about retirement and thinking about not having to work forever. And generally that's what drives the type of people who come to us for advice. Next question from Ravi. Will properties already exchanged due to complete in 2021 fall in price? Will there still be a demand from tenants when the risk of wages at jeopardy due to failing companies due to coronavirus? Okay. All right, so let's talk about, in answering that question, what generally happens to the property market in a crisis. So if we look back at the last financial crisis, which was a credit crunch directly linked to property. The property price in 2008 fell by 8% on average across the UK. Property price in 2009 fell by a further 8%. And then the market turned positive again. However, properties in central locations close to a lot of employment, rental yields actually slightly increased. Now, the reason rental demand slightly increases in a recession is that's where in those locations that's where you have the most jobs. More thin job markets, like more regional areas. If one big company shuts down, a lot of people lose their jobs, and those people flock to where the jobs are, which tends to be the major cities. So properties will definitely still rent. You mentioned about people losing their jobs due to companies failing. That may happen. I think probably without doubt, the unemployment rate will rise, at least over the short term. But remember, unemployment rates are at all-time lows. So it's not necessarily, Armageddon type situation if that figure rises slightly. And so far as buy-to-let goes over the long term, so long as you have invested using the right fundamentals, similar to what I went through before, we can be very confident that regardless of what happens to prices in the short term, that they will come back pretty strongly over the mid to long term, if you have those right fundamentals. So I wouldn't be too worried about properties completing in 2021. We're at the start of, well, not the start, we're in the start of the second quarter of 2020. And we will get much more of an understanding of what the economic and therefore property impact is going to be over the coming months. But if you invested in good properties in good areas, which Ravi, I know for a fact you have, you're concerned about values or rentability. Okay, next question. What do you believe are the best strategies moving forward? Okay, all right, so fairly general question, but I suppose I can answer it as best as referring back to what I went through before. Thanks, Terry. I'm glad you found it useful. Hopefully get to meet you at some point soon. What is the best strategy moving forward? Without a doubt, the safety in centrally located desirable properties, as I mentioned, especially when there is a little bit of uncertainty. You don't want to be taking too much risk in the current market. So therefore, invest in markets with as much depth as possible in tenant pools, employment, facilities, and amenities. Have the most reason for people to want or need to live in a certain location and in your property. And therefore, you can be confident in rentability and salability. That is the best strategy. Now, some people might call that sort of vanilla buy-to-let and not all that sexy, but it doesn't matter. 25 to 30% returns per annum is sexy. That's a really good return. And if you can get that every year, on average, for a period of 10 years, you've done really well. And therefore you'll be able to remortgage, reinvest, build your portfolio, and actually work toward, proper goals. Whereas more speculative type of investing, you take more risk, and in bad times, you generally do worse. So in short, I'd say that's the best approach. Lots of questions, guys, which is great. Thank you very much. Next question. Which is the best part of the country? Okay, so sorry, I just need to. Which is the best part of the country for buy-to-let now, and why? Okay, in my opinion, okay, I'll relate it to myself. I've just bought 2 properties in the past couple of months. One in Manchester, which I've just exchanged on. One in Liverpool, which I'm just about to exchange on. Manchester city centre has got quite expensive, so I've invested just on the fringes in Salford, which is a 5-minute walk to the centre of the city. I've got that at about a 20 to 30% discount to what properties right in the centre of the city are selling for. It will yield at about at 6% on the asset value, and it will give me about 8% net yield on the cash I've invested. And I'm very confident in growth potential as it's just on the fringe of a major city that's growing quite quickly. That's Manchester. Liverpool, the property I'm buying, is right in the centre of the city. Very well priced in comparison to other properties. It will give me about a 10% net yield on the cash I've invested. And with everything that's going on in the centre of the city there, should grow in value well also. Both of these properties will rent every day of the year without doubt. Well, maybe not without doubt, but very, very confident in strong rentability and confident that will grow in value over the long term. In my opinion, those types of properties in those types of locations, predominantly Birmingham, Manchester, Liverpool, being major cities that are undervalued with strong growth factors underpinning those cities, in my opinion, the best places to be investing, and those are the reasons why. Next question. What do you suggest for buy, refurbish, refinance, especially short-term financing for refurbishment? Example, converting a bungalow to a 2-story, 4-bedroom buy-to-rent house in the southeast, approximately 150K short-term finance. What do I suggest? Okay, I'm not quite sure I understand the question here. Okay, so Abid, if you don't mind just putting that question that you've just asked into the question and answer section. You put it in the chat section, but if you put in the questions and answers, I'll actually answer it when I get through the others. And Stephen, I'm glad that you found it useful, and I hope that we can be of assistance sometime soon. Okay, so Sanjay, you asked this question about financing buy, refurbish, refinance. I assume you're asking me what are my suggestions with regards to actually financing them. And generally, bridging is the most used type of finance for that type of investing. But as I think I've already covered, that's not really the type of property investment that we specialize in. We definitely can arrange the finance for it, but we don't generally advise clients on buy, refurbish, refinance. Mainly because, as I say, our clients are more passive style investors. Next question. What type of system is good? Type of system is good. The limited company or partnership or the hybrid to run property because of Section 24. Okay. There's no one answer to this question. And when you say system, I assume you mean buying structure, so far as the ownership of properties. There is no one answer. The reason there is no one answer is it very much depends on your situation. One answer I can give is if you're a basic rate taxpayer, meaning that you're earning less than 50 grand per annum with your property income plus your employment income, If you can keep that less than 50 grand, then you're definitely better off just buying in your own name. Don't change anything, because there's no real benefit of limited companies or other structures, because Section 24 does not affect you if you're a basic rate taxpayer. That means your total income is under 50 grand. In that scenario, you're better off buying in your own name. If you're a higher rate taxpayer, meaning your income's higher than 50 grand, then you can consider these other buying structures. The most simple is limited companies. That's what most people are doing. That's what I personally, and it's what most of our clients do. Whereas the partnerships and hybrid structures are potentially more suitable for people with larger, more complex portfolios, but that's arguable as well. Again, not specifically my area of expertise because I'm not a tax advisor, but it is something that we advise our clients on in a general sense, specific to their situation. So happy to answer that question in more detail, specific to you if you like. Okay, David. So what other charges are involved? Okay, so this is with regards to our services. As I say, we only really charge fees when we do something for you, and the charges the fees that we do charge depend on what we're doing. So anything that we're doing for you, or prior to doing it for you, will be very much disclosed with regards to any fees. But we try not to charge you when we don't have to. We always try to get fees from elsewhere where at all it is possible. Hopefully that's a useful answer. Okay, Tom. Oh, what's happened here? Tom, so can buy-to-let still work in the Southeast? In the right circumstances, buy-to-let definitely can still work in the Southeast, but it's much more difficult to justify, especially when you compare it to other areas where the numbers definitely stack up better, without a doubt. And I suppose in my view, investing in property should very much be unemotional and commercially minded. It doesn't need, your properties don't need to be around the corner from you, because if you've got a good property manager in place that can look after that for you, surely that's better than doing it yourself anyway. So I suppose my answer to that would be, well, yes, it can work in the right circumstances. But if we've got a property in the Southeast that has half the yield and potentially less growth potential than a property in the Northwest, for example, why would you invest in it just because you live in the Southeast? I don't think that makes sense. I would prefer to invest in the property in the Northwest, which has more potential from an investment perspective, because that's why we're investing in the first place. That's my opinion. But yes, it can work in the right circumstances. It's just more difficult. Next question. What will be the effect of government spending, the government spending free on, look, the government spending spree, so I assume you're referring to the stimulus that's been announced with regards to COVID-19 and what impact that might have on property in the future. Anybody who tells you they know the answer to this question, I think is being disingenuous or not being truthful. No one knows. Economics always has two sides to the story. Obviously, printing money or that sort of thing is going to have an impact on inflation. But keeping in mind that inflationary periods are generally very good for property. So, stimulating the economy usually has a really positive impact on property. So potentially in the short term, it could be a good thing or not. I don't think anyone really knows the short, medium or long-term exact impacts that the current scenario is going to have on property. But relating it back to what I've already said, if we're investing in desirable properties in good locations, it doesn't really matter, because we can be confident they're going to rent and we can be confident they're going to grow in value over the mid to long term. Next question by Tom. Is there a risk that if I use the payment holiday on my buy-to-let, tenants stop paying, that it could impact future lending or your credit score? Good question. To be honest, I'd have to find this out specifically, and I think it would depend on each individual lender as to whether you take a mortgage holiday, whether that will actually negatively affect you in the future, or whether it will affect your credit score. I don't believe it does, because essentially they're not giving you money off. Usually if they give you 3 months of paying nothing, they simply add that 3 months on the end of your mortgage period. So I would only do it if you have to do it. If you don't have the funds to support your property in the short term, then of course take advantage of the current mortgage holidays being offered. If you don't have to, then don't. But I wouldn't have thought it will affect your future lending, but I'm not 110% certain on that. Although I am the principal of a brokerage and I am a qualified mortgage broker, I haven't done a mortgage in some years. So I would need to consult on that to find out a specific answer, but happy to answer it for you more specifically face to face. Okay, next question by Andrew. Can you tell me about the property management service we offer? Okay, so we have property management services in all of the major cities that we operate, being London, Birmingham, Manchester, and Liverpool. We have some somewhat unique offerings for our clients where we can essentially offer things like rental guarantees and essentially becoming their tenant, guaranteeing the rent we recommend, things like that. But I can go into that in more detail if you're interested in discussing it. But essentially we focus on those 4 cities from a property management perspective. For usual property management, we charge 8% plus VAT. So pretty reasonable in comparison to the market. Okay, question. Could I please explain section 24? Right, section 24 refers to the changes with regards to the tax deductibility of buy-to-let mortgage interest. So to explain that, before section 24 was announced, buy-to-let mortgage interest was fully tax deductible as an expense against your income. After it's in full effect, it will no longer be fully tax deductible. Now, it's a bit misleading because it says it will no longer be deductible at all, but that's not necessarily true because you do receive a tax credit at 20%, which just so happens to be the basic rate of tax as well, which means that if you're a basic rate taxpayer, it doesn't actually affect you at all. Whereas if you're a higher rate taxpayer and your tax rate is 40%, then you effectively are only able to deduct it at 20%. So it becomes half as tax deductible as it was before. So that's section 24. That's led to a lot more people investing through limited companies, trying to avoid this change. Essentially, more tax on buy-to-let on landlords for higher rate taxpayers. Next question. What is your view of saturation in city centre locations? Okay. So yeah, this is a common question that people get concerned about oversupply. It obviously depends on the city you're talking about, but in pretty well every major city in the UK, there is an undersupply of properties as opposed to an oversupply. One area that was oversupplied was Leeds prior to the previous financial crisis. It was oversupplied. And that became pretty obvious coming closer to the crash, but well, not really a crash, the recession, the downward period, I suppose is a better way of describing it. View on saturation. So it depends what city we're talking about, but one area that has had a lot of media around potential oversupply is Manchester. There's lots of development happening in Manchester, but so there should be. For example, there was a Financial Times article about 6 months ago, which talked solely about the supply side of the equation in Manchester without considering the demand side of the equation. This is where a lot of people go wrong. When they talk about the potential for oversupply, they focus on the supply figures rather than balancing that out with the demand side. So, for example, Manchester, there's about 13 to 14,000 units planned for delivery in central Manchester over the next 5 years. Now, in isolation, that seems like a lot. Seems like a lot of properties in a central area. However, the Manchester City Council recently announced there's a requirement for 5,000 properties per annum simply to meet demand. And there's been an average of about 1,500 per annum over the past 5 years. And there's a backlog of about 40,000 already. So when you balance what I've said there demand-wise with supply, there is nowhere near enough supply to meet demand, and that's why vacancy rates are still very low. So saturation can happen, but it's always on a case-by-case basis, and you shouldn't assume that there's going to be too much supply in a city just because there is supply. It always needs to be balanced out with demand. Because if there's really strong demand, there obviously needs to be supply as well. Okay, next question. Hi Paul, I have a 3-bed flat in Morden, Surrey, that was valued at 375k in 2016, but before COVID, it was valued at so this says it was valued at 375 in 2016, and before COVID, it was still valued at 375, and it was all the fundamental. I don't quite understand the question. It was all the fundamental. So where is the 10% growth? So how I'm reading this by an anonymous attendee, so I can't ask them to rephrase it. But whoever wrote this question, the 3-bed flat in Morden, you said it was 375 in 2016. It was then 375 in quite recently. So where is the 10% growth? Unless I was misheard, I don't believe I ever said there was 10% growth in Morden specifically. Perhaps your list, okay. I think what you're referring to is the average 5.5% per annum. Now, when I say the average per annum for the past 20 years, over the past 20-year period, that doesn't mean that every single property in the UK has grown by 5% per annum by any stretch. It means that was the average per annum every year when you look at the whole of the UK. Now, obviously, I don't know anything about this property, but if you overpaid for it in 2016, perhaps that's why it's only worth that same thing today. But I would have thought a property in Morden would have grown over the past 2 years. However, 4 years. However, perhaps not. I don't know anything about the property, so it's hard for me to comment. Thanks, Owen. Hope that we can be of some assistance at some point in the future. Next question by Helen. What's the suggestion for the fixed mortgage, 2 years or 5 years? Okay. Look, this very much depends on your situation as to whether you should fix it all, and if you should fix, for how long. Obviously, rates are now at an all-time. However, a lot of that rate cut hasn't necessarily been passed on by lenders yet because they have had a lot on their plate. And as I say, the mortgage market has somewhat been put on hold. But at the moment, it's probably not a bad thing to be considering a 5-year fixed rate, so long as you aren't going to have to sell or remortgage that property within 5 years. A lot of our clients will remortgage their properties every 2 to 4 years to release equity and reinvest. But if that's not the strategy, and you can lock in a good rate for a 5-year period, that might not be worth considering. But again, it very much depends on your situation. So, I'd seek personal advice on that, and that's something that we can definitely help you with. Okay, we've got 4 questions left. Paul, where is the best area to buy for yield and capital growth? I think I've kind of already answered this question, Abid, with regards to where's the best place to buy at the moment and why. And I suppose that does tie into both for yield and growth. And as I say, I personally think central or central surrounding areas in the likes of Birmingham, Manchester and Liverpool are very difficult to overlook at the moment, given significant population growth, billions of pounds being spent on infrastructure, and all of that will have to contribute toward growth of those areas, really regardless of the economic cycle or the rest of the greater property market. Okay, second last question. Can I purchase new properties through a newly established limited company and then move in at a point, and then move in at a point the existing privately owned properties purchased before the inception of the limited company? Okay, so this is somewhat similar to the first question that I had with regards to moving properties from your own name into a limited company. The answer is yes, you can do it. but there are costs associated with it. Actually, it's the same person that asked the question. Okay. So can you purchase new? Yeah, so you can definitely purchase new properties through a limited company, and you can move already owned properties into that limited company. However, there will be costs of doing it, like capital gains tax, like stamp duty. You could apply for relief of that, but there is no guarantee in getting it. Hopefully that helps. And then lastly, do we charge 8% plus VAT for managing HMO properties? No, we don't. We don't manage HMO properties. It's a specialist area. Okay, guys, so that's all the questions. I hope that you all found it useful. As I say, we'll send a follow-up email and text to the webinar attendees. So if you would like to have more of a chat about how we might be able to help, then please do so. I really hope that you found that everyone's well and that your families are well. I know it's a bit of a worrying time at the moment. So thank you for attending. Thank you for listening to me prattle on for 90 minutes. I hope you found it useful, and have a great day. We are doing these webinars every week. There's a different topic on next week, so feel free to come back for some slightly different content. And best of luck to everyone. Thanks very much.